Hello everyone! As we do at the beginning of each quarter, we're going to share with you the main insights that can be extracted from our digital top-down methodology. Our method consists of evaluating the attractiveness of European equities with regards to 4 complementary pillars of analysis. The first pillar focuses on the economic growth momentum in Europe. The latter has rebounded strongly over the past 3 months due to sentiment indicators that are recovering from historic lows in some cases. The recent fall in inflation and the reopening of China are contributing to the gradual improvement in visibility, which is generally a powerful support for equity indices after troubled periods. At the same time, economists have stopped downgrading the economic outlook in Europe for the past 2 months, for the first time since the invasion in Ukraine. The second pillar deals with the monetary policy implemented by the ECB. As expected, the rate hike was rapid and intense, even if the 50 basis points increase observed in December on both sides of the Atlantic is the first signal of a less restrictive inflection. The previous rate hike was indeed 75 basis points. Raising rates and causing a technical recession is the only way for central banks to fight the worst danger an economy can face: inflation, and it seems to be successful. The inflation peak is now probably behind us, especially as the first anniversary of the invasion of Ukraine approaches. The contribution of food and commodity prices should soon reverse and turn negative. The third pillar of analysis is European market valuations. The risk premium of European equity markets stands at 5.7%. This is a generous level compared to the historical average of 5%, but below what we were able to see at the end of September. The recent easing of the risk premium is explained by the violent rise in equity indices and interest rates in the third quarter, as well as slight downward revisions of the earnings expectations by the analyst consensus. The sharp rise in equity indices and rates in the third quarter, as well as the slight downgraded revisions to the earnings outlook by consensus analysts, explains the recent easing of the risk premium. Finally, the fourth pillar covers the behavioral aspect. European indices are once again in an uptrend, as they have been trading above their 200-day moving average since October for the first time since the invasion in Ukraine. Moreover, they are maintaining a long-term bullish chartist pattern as long as the technical support corresponding to the historical highs of 2000 and 2007 and the lows of 2022 holds. Finally, as we enter 2023, equity markets, which are 12 months ahead of the real economy, are now looking forward to 2024. 2023 will undoubtedly be a difficult year on the economic front with an expected recession. However, with earnings up nearly 20% in 2022, coupled with a decline of around 15% in European indices, it seems to us that a tough scenario has already been anticipated by the markets over the past year. Improved visibility could continue to support a cheap European equity market, as we have seen since September end. Thank you, and see you next quarter for a new video by Shaheen Capital.